So far, 2025 has been action-packed, and it has been fascinating to observe the ebb and flow of capital within and across asset classes at a time of heightened uncertainty, where the investment rulebook of old is being challenged. It's clearly the case that investors feel vulnerable given the numerous unpredictable policy announcements from the US administration, and in turn, how policymakers in other countries and jurisdictions are reacting. Looking at the data, we can see that there have been some interesting and surprising responses by investors as they rethink their asset allocation constructs. Firstly, there's a definite want to reduce US equity market exposure, and we can see that in the flow data, as flows into US equity products in the UCITS space are 50% below where they were over the same period last year. In fact, we've had numerous discussions with investors about ways to mitigate US market capitalization risk, and in some cases, how to reduce US equity market risk outright. In that respect, US equal weight, factor, sector, and ex-Mag 7 products have been of interest as market cap alternatives, with these collectively seeing a sharp pickup in inflows in 2025 compared to the meaningful outflows we saw in 2024. Indeed, we saw something similar regarding China equity market exposure at the nadir of the equity bear market last year. Many investors have since been looking for ways to carve out their China equity market risk from broader EM benchmarks and manage it separately. This led to sharp inflows into EM ex-China equity products as well as standalone China equity products since the start of the year. So there are clear signs that risk-taking is becoming more tactical and granular. We can see this given the popularity of country allocation this year, where there has been a rotation between countries, particularly within the EM equity space. Country stories such as India, Indonesia, Brazil, and more broadly Latin America have been a focal point for many investors. European and Chinese equities have also been popular country allocation choices too, with China seeing inflows almost 5 times bigger than over the equivalent period last year. In the fixed income space, we've seen a similar disaggregation of global exposures given the behaviour of US Treasury markets and JGBs, particularly at the long end of curves. Investors are keen to diversify away from US Treasuries towards other government bond exposures, such as European government bonds, to enable them to retain government bond exposure but in a more diversified form. There has also been a preference to shorten duration and to gravitate away from government bonds towards investment-grade corporate credit, given the high all-in yields and perceived relative stability of corporate issuers. So overall, we have seen a continuation and intensification of the notable, prominent trend of more granular, tactical risk-taking that began in 2024, given the heightened volatility and fragmentation we are seeing across and within asset classes.